This is The Memo by Howard Marks. Today, another episode of Behind the Memo, in which Howard sheds some light on themes from his most recent memo. Here he is discussing what really matters with Oaktree senior financial writer Anna Szymanski.
So Howard, this memo weaves together many themes, including several you've discussed in previous memos this year. So what made you want to tie all of these ideas together in a new memo?
Well, you'll recall that 2 memos ago, I guess it's 3 now, I wrote, I beg to differ. And that was about the importance of diverging from the herd if you want to have superior results. And you'll recall that it ended talking about my remarks at our June 21st conference in London and the fact that people were asking me about inflation, about interest rate increases, and about the recession that will result from the interest rate increases. My thinking about it over lunch and coming back on stage and saying, you know what, all that stuff was short term, and that's not what matters. The job of the institutional investor, our clients, is to have more money 10 years from now, 20 years from now. So those can't be the things that matter. What I said in that memo is if you want to diverge from the pack and distinguish yourself, think about the long term, not the short. Obviously, that stayed with me. Then we had the illusion of knowledge, which was basically about the fallacy of trying to predict macro events. And most of that is about the next year or two. Most people are not predicting growth for the next 10 years, which, if you think about it, that's what really matters. Number 1, short term, no. Number 2, short term, no. So it's kind of like a cumulative effect. And I just felt like writing a memo about how unimportant these things are. Short-term events, short-term trading, short-term performance. This is not what it's about.
One of the things you say in the memo when you're talking about this problem of short-term thinking, you write, some people say that the long run is a series of short runs. And if you get those right, you'll enjoy success in the long run. So why do you believe that idea is inaccurate?
Well, if you follow that to its logical extreme, then you'll be a trader. Every time you buy a stock, you buy it because you think it's going to have a great next hour. Let's go back to 1999. In the fall of 99, I was writing the first memo that got any real acceptance, and that was bubble.com, in the throes of the TMT bubble. One of the interesting phenomena of the TMT bubble was the day trader. You could buy and sell securities, but you couldn't carry any positions overnight, because for that you would need capital, and presumably you didn't have capital. Obviously, all you did was bet on what was going to happen that day. It's the kind of thing that worked until it didn't. Think about a typical day trader investing in a given stock, a TMT stock, and it's on an upward trajectory. I think I said in that memo, here's your day trader. He buys it at 10, he sells it at 10 and a quarter. Then he buys it at 12 and he sells it at 12 and 3/8. Then he buys it at 15 and he sells it at 15 and a half. Then he buys it at 18, he sells it at 18 and a quarter. And he says, look, I made over a point with no money at stake. What a great job I did. And he ignores the fact that the stock in this period went from 10 to 18 and a quarter. He made 1 point at a time when the stock was up by 8 points. Now, it was the best you could do if you had no capital, but it wasn't a very valid activity. And where do you get the information and the inputs to help you figure out what a stock is going to do that day? That's the short run. That investor probably thinks that life is a series of short runs, and he did well in 4 short runs, but he certainly suboptimized vis-a-vis the long run. The more you worry about short-term price fluctuations, the less you can concentrate on, I don't care what it's going to do this year. I think it has a great 10-year future. And isn't that what really matters? At Oaktree, we don't consider ourselves market timers. As I said in I Beg to Differ, is we try to buy ownership stakes in companies that will become more valuable over time and buy the bonds and other credit instruments of companies that will pay interest and principal as promised. That's a long-term focus.
And it speaks to what you say in the memo about the difference between really being an investor and essentially being a gambler.
Oh, yeah, because you don't know anything about the next hour or the next day or the next week, or I think the next month, or the next quarter. But when you get out to years, you can know something. Let's remember the Ben Graham quote that in the long run, the market is a weighing machine, but in the short run, it's a voting machine. In the short run, it's popularity that moves prices, and that is absolutely unpredictable. In the long run, hopefully it's a weighing machine. Price moves in response to changes in long-term value. Hopefully, with hard work and skill, you can anticipate what that's going to be.
And that makes me think of, what you talk about in The Illusion of Knowledge, this idea of knowing what you can't know so that you can then focus on what you can know.
Yeah, I always remind people, Warren Buffett said to me one time that for a piece of information to be desirable, it has to satisfy two criteria. It has to be important and it has to be knowable. So everybody focuses on how important it would be to have advanced knowledge of the macro or the advanced knowledge of what's going to go up the most today or this quarter. But these things are not knowable. And so it's wrong to spend your time on that. It would be great, but.
One of the things you also write when you're talking about short-term thinking, you say that short-term performance is simply one result drawn from a full range of returns that could have materialized, and it can be heavily influenced by random events. I think that's a really important point, so I wanted you to talk more about that.
Yeah, I've written about it before. This is not deterministic. The future doesn't exist. The future is not going to come into existence in response to some rules and first principles. Mm-hmm. There's a lot of randomness. There's a lot of hidden information. And there's a lot of psychology that creates the future. In the long term, these things tend to iron out. But in the short run, they dominate. So I used the imagery of drawing tickets from a lottery or balls from a bowl. Let's say there are black balls and white balls, and the black balls are good and the white balls are bad, and they exist in a bowl. And you get a prize based on what you pull out. So sometimes you pull out a black ball, some pull out a white ball. Every future consists of a probability distribution of possible outcomes. It's not just one future. There's many futures, but the future is unknown. You're going to reach in the bowl and you're going to pull out a ball. Elroy Dimson characterized risk brilliantly by saying, risk means more things can happen than will happen. There's a range of possible outcomes. If there was only one, then there'd be no risk. Well, if there was only one and you could ascertain it, but there are many. And I inverted that in a memo called Risk Revisited Again. And I said, even though many things can happen, only one will. So there's this concept that there are many possible outcomes, but there'll only be one ball drawn from the bowl. But it doesn't tell you that you draw a white one. You can't say, well, I guess that means all the balls in the bowl were white or vice versa. But I think to torture this analogy a little further, the more time you take, the more the balls in the bowl migrate. So that if the company is a good company, it performs well for 10 or 20 years, and its future is bright, then you tend to have more black balls in the bowl and not too many white ones, and vice versa. Doing these things in the long run, based on fundamental considerations, I think there's more likelihood that the outcome will hew to the reality than there is in the short run when so much randomness is involved.
Yeah. It also made me think of some of the things you've written in memos like You Bet about understanding and analyzing decision making and whether something's a good decision or not just based on the outcome.
Yeah. And well, I always tell the story that the first book I remember reading at Wharton, which now, incredibly enough, next year will be 60 years ago that I got to college, was a book called Decision Making Under Uncertainty, about how people make decisions in the oil and gas patch by C. Jackson Grayson. What I took away from that book more than any other one thing is that you can't tell the quality of a decision from the outcome. Again, so many random and unknown and hidden and unknowable things influence the outcome that good decision makers are wrong all the time and vice versa. But the longer you let the process cook, the more the outcomes collect around reality and fundamentals, I think the more dependable this process is. It's all about trying to be more dependable and take the luck out and take the surprises out.
I'm going to pivot a little bit to a point that you make in the aside about private investment funds. And I thought this was a really important point that you make. You say that a number of people are asking, why are private investment funds reporting so little volatility when there's been so much volatility in public markets? And you say, well, maybe they have been reporting too little volatility, but shouldn't the question also be, are public markets reporting too much volatility?
Well, people tend to say that the price moves of public securities are right and good because they are what really happened in the real world. It's demonstrable that General Motors went from 40 to 60 or 60 to 40. So that's the standard for rightness. If in the same environment, General Motors is down by a third and private equity is down by 2%, They tend to say, well, obviously it's not volatile enough. And maybe the volatility in privates is undermarked. But, I believe strongly that the volatility in public securities is excessive because it reflects this manic depressive character called Mr. Market. He can't make up his mind. I feel very strongly that the public markets are too volatile. And so it would be wrong to say that the private markets should be as volatile as the public markets. If you owned a whole company and you thought that its long-term future potential was undiminished, how much should its stock price go down? How much should its valuation go down in a bad year? That's really the question. But Anna, remember that the aside on the subject of the private marks is within or related to the discussion of volatility, which I put under the heading of what doesn't matter. It's one of the 5 things that I list in the memo as not mattering. The investment world pays so much attention to volatility, and they turn down things because they expect them to be volatile, or they mark down a manager's performance if he exhibited volatility. But I just think that volatility is a temporary fluctuation. Like in bonds, the price was volatile, but you bought it at par and it redeemed at par. What does it matter? As long as the credit was not impeached, what does it matter how much it fluctuated while you held it? If you took a bond and locked it in a drawer from the day you bought it until the maturity date, and you didn't know that its price went up and down, and you got paid off at the end, was it risky? Hard to say it was.
Yeah, and that really speaks to what you talk about in the memo, this confusion between volatility and risk.
Right. Well, I always say I went to Chicago just after the Chicago School of Finance gifted the world with its conclusions, one of which was that, of course, return has to be evaluated in the context of the risk that was taken to get it. If I invest in T-bills and I make 7% and you invest in venture capital and you make 7.5%, I probably did a better job because I took no risk and I produced a return almost as good as yours. But to turn it into a formula, they had to have a number. We have a number at the end of the year for what your return was. We need a number for the risk. Where can we get that number? I believe that risk is the probability of something bad happened. Where can you look that up? And the answer is no place. The probability of most future events is a matter of opinion. So what are you going to put in the formula? So, well, why don't we use volatility? Because the degree to which a price fluctuates maybe gives us some insight into whether or not it's risky or not. Well, there might be some little relationship there, but volatility is not risk. In my memo, Risk Revisited Again, I think I say that risk is something that you may want to limit, you may want to avoid, but if you're going to take it, you certainly want to get paid for it. Mm-hmm. My colleagues at Oaktree say, well, if we're going to buy that, it's pretty risky, we should get a high return. Makes perfect sense. I never heard anybody say, well, it's going to be volatile, so you should get a high return. Volatility is not the risk that professionals care about in the industry, in my opinion.
Yeah, and when people say markets are volatile, they usually mean markets are weak.
I love it because they say there could be volatility ahead, and they don't mean on the upside. They mean on the downside, but they don't want to say that.
Yeah. Okay, so we've talked a little bit about what doesn't matter. So maybe let's talk about what does matter. At the end of the memo, you talk about asymmetry and why that's so important.
When I write these memos, I usually have a list of ideas. I rarely have an outline. And usually the finished memo includes some stuff I had never had in mind. Well, first of all, including volatility as one of the things that doesn't matter, that was kind of an afterthought. And the aside about private marks was an afterthought to that afterthought. And then at the end, I talked about the things that I always say are important, which is risk control and knowledge advantage, not trying to time markets and having a creed, understanding the things you believe in and don't believe in, the things you will do and the things you won't do. I think these are very important. But then it popped into my mind to talk about asymmetry. Asymmetry is a concept that I've always considered important. If you have somebody who's the market's up 10 and he's up 10 and the market's down 10 and he's down 10, he doesn't add any value. He shouldn't get paid. If you have another manager who the market's up 10, he's up 5, the market's down 10, he's down 5, he shouldn't get paid either. He's a no value added manager with a beta of a half and so forth. If you don't get paid for beating the market on the upside and losing a lot on the downside, what should you get paid for? And the answer is you should get paid for doing better in the good times than you're hurt in the bad times, having more winners than you have losers, having your winners be more profitable, then your losers are costly. An important sign of an asymmetrical manager is that when your strategy or approach is in favor, you do really well. And when it's out of favor, you do okay, and so forth. And then I explore in depth in that section the fact that asymmetry is indicative of the presence of alpha, which I define as personal skill. Turned around, alpha is the necessary condition for asymmetry. You want asymmetrical managers. If you're an institution, you may want to put together a portfolio of managers, including some that are asymmetrical and defensive and some that are asymmetrical and aggressive. But if that's what you can find and combine, all of them will do better when things are in their favor than they are hurt when things are against their favor. And that would be a great portfolio to have.
This makes me think of something that you write about in this memo and most of your memos you've written about this year, which is this message that I think people might not want to hear, which is that superior investing is really hard. Yeah. As you say, you need to be able to be asymmetrical. You need that skill.
Yeah. I think in the preface to one of my books, I said, my goal is not to make investing easy. It's to show you how hard it is. Nobody I know does their own medical work, their own dental work, their own legal work. I can't do my taxes anymore. Nobody fixes their own car anymore. So why would one believe that people can be their own investor? This was popularized. People were sold investment services. I think what the individual can do is they can set the course for themselves. They can look for managers who embody the properties they're looking for and then delegate the task or put your money in an index fund. The most important thing is to be in the market for the long term and not screw it up. Don't interfere. I think it's very, very important. You know, everything in psychology tends to make us do the wrong thing at the wrong time. Get excited when prices are rising and you want to buy, and you get depressed when prices are falling and you want to sell. And those things are exactly the opposite of what you do. So it's kind of like I say in the memo, I talk about the factory of the future, the automated factory of the future, which has one man and one dog. And the dog's job is to keep the man from touching the machinery, and the man's job is to feed the dog. But it's the same thing. I think that investors should try to figure out a way to keep their hands off the machine. The machine is the long-term success of the economy and the companies. Everything else is kind of like, I say, embroidery around the edges. But get into that and stay with it for the long term. Now, if you think you're smart and you think you can get in, get out, or pick which stocks to overweight or underweight, or the industries to favor or not, you could try, and some number of people will add in that way. But the main attraction is the long-term participation in the economy. I think I say in the memo that for the last 100 years, roughly speaking, we've lived through 16 recessions, one Great Depression, numerous wars, one world war, now one pandemic, numerous moments of geopolitical turmoil, and yet the S&P has risen by 10.1% a year for 100 years. This was the American century, the 20th century. I don't think it's necessarily going to make 10.1% a year for the next 100 years. But I think it's going to give 7, 8, 9. Lately, I've taken to quoting Bill Miller, who was one of America's great investors. He beat the S&P for 15 years in a row, which is a Herculean task. He said, it's time, not timing, that builds wealth in the stock market. And that's what people should reflect. So, yeah, I don't think people should be trying trick shots.
I thought it was telling that you used that quote in your first memo of the year in January, and then you used that quote again.
Yes.
This is your 7th memo this year. And so outside of 2020, it's the most memos you've written in any one year in the last decade. So why do you think you had so much to write about this year?
I think as I get older, my brain becomes more fertile. I think when you get older, if you're still active and you're paying attention to what's going on, you just see things. Things that used to perhaps seem like random occurrences take on patterns and teach lessons. And I really think it's that. The great thing about investing is that I think that I understand things every year that I didn't understand the year before. On the one hand, you have to have a framework and a belief system. And on the other hand, you should be evolving every year.
What would you say you learned this year?
This year, I focused on things like starting with selling out. In 32 years, I'd never done a memo that talked about selling and talking about the fact that people trade too much and it's not an advantage. Beg to differ, the importance of being different, not for its own sake, But if you don't have some unique ideas, how are you ever going to be a superior investor?
Mm-hmm.
And then the illusion of knowledge. I've always talked about the fact that I don't respect macro forecasting, but I never really went into depth in why. So that was important. And then I really enjoyed a book over the summer, Mistakes Were Made, But Not By Me, which is all about self-delusion. And I really enjoyed bringing in something from another discipline, which is psychology, which is why is it that people keep making forecasts, even they don't know work, and they keep doing it. And when they get some data which shows that their forecasts were not good or that forecasting in general doesn't work, how do they dismiss it? And of course, cognitive dissonance. And then with this memo, I'm writing about the unimportance of short-term events and short-term performance. And then I get this idea, well, I should say how much I think volatility is unimportant. The quote there, probably the memo is unnecessary. All I had to do is quote Buffett, who says, I'd rather have a lumpy 15 than a smooth 12. As I say in the memo, if you'd rather have a smooth 12 than a lumpy 15, yeah, you should figure out why. And then, of course, ending up with the discussion of asymmetry, which is a major topic. And if somebody has asymmetry, they're valuable. And if they don't have enough skill to produce asymmetrical results, then they're not valuable, period. I don't think I wrote anything in any of these memos that I didn't know a long time ago, but over time they become crystallized. Mm-hmm. And that's what I think happened this year. And I hope some will be crystallized next year.
I'd say that's a great place to end.
Thank you for those great questions, Anna.
Thanks so much.
Thank you for listening to The Memo by Howard Marks. To hear more episodes, be sure to subscribe wherever you listen to podcasts. This podcast expresses the views of the author as of the date indicated, and such views are subject to change without notice. Oaktree has no duty or obligation to update the information contained herein. Further, Oaktree makes no representation, and it should not be assumed that past investment performance is an indication of future results. Moreover, wherever there is a potential for profit, there is also the possibility of loss. This podcast is being made available for educational purposes only and should not be used for any other purpose. The information contained herein does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities or related financial instruments in any jurisdiction. Certain information contained herein concerning economic trends and performances based on or derived from information provided by independent third-party sources. Oaktree Capital Management, LP, Oaktree, believes that the sources from which such information has been obtained are reliable. However, it cannot guarantee the accuracy of such information and has not independently verified the accuracy or completeness of such information or the assumptions on which such information is based. This podcast, including the information contained herein, may not be copied, reproduced, republished, or posted in whole or in part in any form without the prior written consent of Oaktree.
Audiation.